Most people keep waiting for a big Black Monday style crash. They picture chaos on trading floors, charts falling straight down, and news anchors shouting, but
Layoffs.
YouTube and Meta have all announced new rounds of layoffs.
that is not what this looks like. The real AI crash started months ago, and most people missed it. It is not loud. It is slow. It shows up as your buying power getting drained while the headlines brag about record highs. While the news talks about the market being strong, something underneath has changed. The numbers do not add up the way they used to. If you still use stock prices to judge how the economy is doing, you are watching the wrong thing. You need to look at the parts people do not see. You need to look at the systems that keep everything running because they are starting to fail in quiet ways. Start with the basic promise that used to hold for decades. For about 50 years, computers followed a simple pattern. They got faster and cheaper over time, year after year. People built plans around that. Companies built entire business models around that. But in January 2026, that pattern broke. TSMC makes the most advanced chips used in modern AI. If you use ChatGPT, Gemini, or Claude, you are using chips tied to their work. Now, TSMC is raising prices again. This is not a tiny change that matches normal price increases. If a company wants the newest 2nm chips, the ones needed for the next wave of AI systems, the cost is no longer around $20,000 per wafer. It is now over $30,000. That is a huge jump. It means the base cost of building advanced AI is rising, not falling. That shift forces a hard choice for companies. When the core material gets more expensive, the final product usually gets more expensive too, or the business starts failing. Large companies can absorb this longer. A company like Nvidia has cash and scale. It can take the hit for a while, but thousands of smaller AI companies cannot. Many of them already burn money just to rent computing power. When chip costs rise, the cost to compete rises too. For many of those smaller companies, it is not a challenge. It ends the game. This is the first big crack. The cost of running AI businesses is rising fast, but the profit is not rising the same way. We are seeing a strange split. Tech stocks can rise while the cost to operate the business underneath rises even faster. These companies spend huge sums to chase growth, but the return does not match the spending. It becomes a cycle where they spend billions and pull in much less new revenue. That kind of math cannot hold forever. And when big companies face higher costs, they usually pass the bill to the public. Right now, big tech spends more than $600 billion a year on AI and related infrastructure. That is a massive amount of money. It is bigger than the entire economy of many countries. Companies are building huge data centers. They are buying large amounts of copper, cement, and backup power gear. They are treating this like an arms race. But here is the key question. Where is the payoff? People were promised a huge shift in outcomes. They were told AI would quickly create major breakthroughs and unlock large new value. Instead, most people see tools that are useful, but not life-changing at the scale that matches this spending. AI helps with work, writing, and search. It helps with support and planning. But does it justify $600 billion a year in spending right now, year after year? This is where the quiet worry is growing. Analysts talk about a gap between spending and return. They see companies buying chips and building data centers, but they do not see enough extra revenue coming back. Most people are not paying for premium AI. Now add the second wall, and it is not about money. It is about electricity. These machines need power, a lot of power, and we cannot build new power supply fast enough to feed the pace of growth. Look at Ireland. Data centers there are on track to use about a third of the country's electricity. That is not a small share. It means a major chunk of national power gets pulled into server buildings. In the United States, grid operators have started pushing back. In some places, they are telling tech companies they cannot connect new projects as fast as planned. When the grid cannot support the demand, projects get delayed, costs rise again, and the AI build-out hits a hard limit that no software team can fix. This is where the story hits regular people directly. The public hears the word efficiency, but the real effect is job cuts. In late 2025 and early 2026, large tech firms announced layoffs.
YouTube and Meta have all announced new rounds of layoffs.
These were not companies failing. These were companies still earning big profits. So why cut workers? Because they need cash for chips and data centers. That is the trade happening right now. Money that used to go to salaries now goes into hardware spending. This is a quiet transfer from middle-class paychecks into the AI supply chain. Your job is not always being replaced by a robot walking into the office. In many cases, it is being replaced by a budget decision. A team looks at at costs and says, "We need more GPUs, so we need fewer people." That is what the silent crash looks like for workers. Not a movie scene, just a decision on a spreadsheet. And for everyone else, another result shows up. Price increases. These companies still need to close the gap between what they spend and what they earn. One way to do that is raising prices on software and services. Many people already feel this. Subscription prices rise, cloud storage rises, tools rise, entertainment rises. It is not one bill. It is many small bills that stack up. In the end, you pay for the spending wave even if you did not ask for it. So if the math does not work, power is limited and workers get cut, why do stock prices still look strong? One answer is that insiders sell while the story still sounds good. Look at company filings and you will see big sales. Many top leaders have been selling large amounts of stock. They are not buying more at these levels. They are taking money out while excitement stays high. They see the limits. They see the spending wall. They see the power wall. They see the risk that returns will not catch up in time. So they lock in gains while the public still feels hopeful. This pattern is not new. It looks a lot like the late 1990s tech bubble. The technology was real. The internet did change daily life, but the prices were still too high. Many companies with good ideas collapsed because the market priced them like guaranteed winners right away. Investors could be right about the future and still lose huge amounts because they paid too much at the wrong time. That is the danger now. AI will matter. AI will reshape work and business. But if the market prices that future as if it is already guaranteed and already profitable at scale, people can still lose badly. Being early can hurt the same as being wrong. This is why insider selling matters. It is not proof of a crash by itself, but it matches the idea that the people closest to the numbers want less risk on their own balance sheet. Now let's focus on the energy problem because it is the one problem you cannot solve with better code. The grid is physical. It needs real parts. It needs transformers. Those large metal units on power lines are not easy to replace. Lead times for high voltage transformers can be years. That means a damaged part can take a long time to replace. If a major data center hits a serious electrical issue, it may not be a quick fix. Tech companies are used to fast cycles. They expect quick builds and quick upgrades. Utilities move slower because safety matters. That gap creates conflict, and the grid usually wins because you cannot rush physical limits. At the same time, tech leaders often assume the public will pay for many AI subscriptions. One assistant for work, another for home, another for everything else. But most households are already stretched. Many people are focused on basics like food, housing, and medical bills. The gap between what tech firms want to sell and what normal people can afford is growing. Now go back to the dot-com lesson because it explains the risk clearly. After the bubble burst, even strong companies fell hard. Some took a decade or more to recover to their prior highs. That is what people mean by dead money. Your investment can go nowhere for years while life gets more expensive. The key point is simple. The crash is not always a single day event. Sometimes it starts in other places first. Bond markets, layoff numbers, energy limits, pricing pressure. The stock price often falls last. So do not wait for a dramatic headline to tell you something is wrong. Watch the real signals. Watch the costs. Watch the job cuts. Watch the power limits. Watch insider behavior. The crash is already here for many families. It just looks uneven and it hits different groups at different times. If you want more stories like this, the kind of stories mainstream finance media often avoids or softens, subscribe. The biggest wealth transfers happen when the public is still focused on the wrong screen.